Welcome and thank you for joining us today for the IPERS Understanding Your Retirement series. The goal of this webinar is to give you a more in-depth understanding of your IPERS estimate and retirement options. If you have a copy of your own IPERS benefit estimate, having that near you will be helpful so that you can follow along as we're discussing that. It is recommended that you contact IPERS to discuss your ideas for retirement dates. Sometimes working a little longer than you had planned or even delaying your retirement benefits for a bit can increase your IPERS benefits significantly. Sometimes you may be eligible to retire earlier than you thought. An IPERS representative can review your account and give you information geared to your individual situation. If you don't have an estimate, this is what it will look like when you call to request an estimate or run an estimate online by logging into your account at IPERS.org. Please note that if you're special service, your estimate may look slightly different and the information may not be in the same order as we're discussing, but the information itself remains the same with the exception of the normal retirement age section being eliminated. The first column shows your anticipated retirement date, the month of your last paycheck, and your first month of entitlement. Notice that on the example, the month that the member will leave employment will be December, but the last regular pay will be January. Because they will last work in December, they'll be eligible for IPERS benefits beginning in January. We pay the last business day of each month, so the first payment, as long as IPERS has received a completed application on time, would be January 31st, assuming that's a business day. However, this member has worked long enough into December that they would be paid regular wages in January. Because they're being paid regular wages, not just vacation or PTO payouts, they would receive credit for the first quarter of the next year. You don't have to work into a quarter to receive credit. You just have to be paid regular wages. Note your date of birth is listed. If that's not correct, please contact our office immediately, as that can significantly impact your benefit estimate. For regular members, the early retirement percentage refers to the normal retirement age. If that shows 100%, you've met one of IPERS rules and are at normal retirement age as of the retirement date given on the estimate. If that shows a percentage lower than 100%, that means you've not yet met a rule and would have age reduction applied if you were to retire at that time. If you have someone listed under the Contingent Annuitant section, please confirm that their relationship to you and date of birth is correct. The relationship should read spouse or other. Any errors could impact your option 4 and 6 amounts. In the second column, it lists your membership class, years of service, and multiplier. Near the bottom, it shows your investment amount. If you have more than one estimate, you will probably notice that your investment amount does not change. Your investment amount is the only thing the computer will not project. The contributions listed are current as of the date the estimate was run. In the right-hand column, it lists your yearly salary increase rate, which is normally calculated for estimate purposes at an average of 2% per year, but that can be modified however necessary. The last column also lists your highest average salary estimates. Remember that all of our options are always lifetime to the member. The differences are in the death benefits, if any. It is important to note that once you've received your first monthly payment, your option can never be changed. It is recommended that you contact IPERS to speak with a representative prior to making a decision. If you have a financial planner, it may be a good idea to run your estimate by them so they can help make a good recommendation. The option choices and the amounts are detailed on your estimate. With option 1, it sometimes makes the most sense to think of it like a life insurance. In increments of $1,000, you can choose to leave behind a lump sum guaranteed death benefit up to the amount that you personally have invested into IPERS at the time of your retirement. Your estimate will show under the first paragraph of option 1 what your benefit amount would be if you chose the minimum $1,000 guaranteed death benefit. In our example, if you chose the minimum $1,000 death benefit, your monthly benefit would be $1,600. Then in the next paragraph, it will tell you how much that payment would be reduced by for each additional $1,000 you chose to leave behind. In our example, it shows $1 for each additional $1,000 in death benefits. In the third paragraph, your estimate will show you what your benefit amount would be if you chose a midpoint. And finally, in the last paragraph, your estimate shows what your benefit amount is projected to be if you chose to leave your current maximum allowable death benefit. In our example, the member has an $18,000 maximum, and their monthly benefit would then be reduced to $1,583. Whatever amount you choose to be set aside will be paid to your beneficiary or beneficiaries of choice as a one-time lump sum. That death benefit amount chosen will never decrease, and you will receive your monthly payment for your lifetime. A few things to note about option 1. I said think of it like life insurance because that makes it easier to explain. However, it is not life insurance. It is a lump sum death benefit, and it is taxable to your beneficiaries. With option 1, though, you can change your beneficiaries anytime, even after retirement. You may have multiple beneficiaries. You could leave it to an estate or an entity. It's very flexible in that aspect. Also note that beneficiaries may be eligible to roll all or a portion of the lump sum over to a qualified plan to help them defer the taxes. Option 2 is a promise to pay you at least as much as you've paid into IPERS. And if you die before we've done that, a beneficiary or beneficiaries of your choice would receive the remainder. Now, if you divide your investment amount by your monthly benefit, you will probably find that you would have received your investment amount back within about 3 years. After that time, you will continue to receive your IPERS benefit because it is lifetime to you as the member. That just means there would be nothing payable to your beneficiary after we've paid you back your investment amount. It does protect your investment, though, in the event that you pass early and unexpectedly into retirement. Option 3 is very simple. It's our highest monthly benefit payment, but there is no death benefit, no protection whatsoever of your investment. I'm going to skip to option 5 for a moment. Option 5 is, as always, a lifetime benefit to you, but it guarantees 10 years worth of payments. For example, if you live 2 years, your beneficiary or beneficiaries of choice would receive 8 years worth of payments. If you live 7 years, they'd receive 3 years worth of payments. If you live 10 years, you would continue to receive because all IPERS benefits are lifetime to our members, but then there would be nothing payable to a beneficiary. If you pass before a 10-year period of time and you've chosen one beneficiary, they would continue to receive your monthly payment. If you've chosen more than one beneficiary or have named an estate or a trust, the present day lump sum value would be paid. That lump sum versus monthly payment is detailed on your estimate. I've grouped these together because so far, all of the options we've discussed, you can change beneficiaries at any time if there's a death benefit to be paid. It could be one beneficiary or multiple beneficiaries, an estate or an entity. It's very flexible. The next 2 options do not work in that way. With options 4 and 6, you name a contingent annuitant, not a beneficiary. It must be one person, not an estate or an entity, and may only be one, not multiple people. Unlike a beneficiary, a contingent annuitant cannot be changed at any time for any reason, regardless of death or divorce. Options 4 and 6 are both dual lifetime annuities, which means both yourself and your contingent annuitant will receive lifetime monthly benefits. The contingent annuitant is normally a spouse or significant other, and again, it's important to note that a contingent annuitant cannot be changed at any time for any reason. Option 4 allows you to choose the percentage that you would leave behind for a contingent annuitant. In our example, our choices are 100, 75, 50, or 25%. The less you leave behind, the more your payment is while you're living. Using our example, let's say I've chosen my spouse as my contingent annuitant, and my monthly benefit amount is $1,493.61 at 100%. If I were to pass, my spouse would continue to receive the $1,493.61 benefit for the rest of his life. Then upon his passing, the benefit would end. If my spouse didn't need 100%, perhaps he only needed half of my pension if I were to pass, my monthly benefit would be $1,548.40. But then upon my passing, he would continue to receive $774.20 for the remainder of his life. In either scenario, that does mean, though, that if my spouse were to predecease me and I no longer had a contingent annuitant, I would continue to receive the same reduced amount for the rest of my life, and upon my passing, it would end. Under no circumstances can a member name another contingent annuitant. There is a very small difference between options 4 and 6. Option 6 pays slightly less than option 4 and works in exactly the same way. If you die before your contingent annuitant would continue to receive the amount you've allotted for the remainder of their life. However, with option 6, if your contingent annuitant dies before you, you still can't name another contingent annuitant, but the member would then jump back up to the higher option 2 amount to receive for the rest of their life, so they were no longer taking a reduction in their benefits. In addition, because they are moving back to option 2, it would then protect any unpaid investment of their contributions if any investment amount remained. Now, I'm often asked if option 4 or 6 could have a different contingent annuitant other than a spouse or significant other, and the answer is absolutely yes. If that one person is significantly younger than you, your benefit would likely reduce significantly because we expect to pay them for much longer. And depending on the age difference, they may only be eligible for up to 50% of your benefit amount. If you're considering leaving the benefit to a grandchild, for example, and have multiple grandchildren, please also keep in mind that you would have to choose one grandchild to leave the benefit to, because it can only be one person. You would also want to make sure their date of birth and relationship to you is correctly listed on your estimate as your contingent annuitant to see what your benefit amount would be and what benefit amount they would be eligible for upon your passing. We generally recommend that you contact us 4 to 6 months prior to your anticipated retirement date to get your final estimate and your application. We do ask that your application is returned to us 60 days in advance whenever possible. We understand that retirement can be a time of uncertainty, and our retirement benefits officers are always happy to answer any of your questions. We are available via phone Monday through Friday from 7:30 a.m. to 5 p.m. except for state holidays, or by email at info@ipers.org.